Well, I think the 10-year Treasury is probably grinding lower to a low 2% area, maybe between 2 and 2.25. That has actually been the trend year to date prior to this disappointment on the trade front. But it's also being driven by low inflation. In fact, the Fed moving to the sidelines has been the big driver, I think, so far this year. Now, probabilities of a rate cut, maybe sometime before year end, are starting to become embedded in prices.
Yeah, I mean, the rate cut odds went up to past 100% for December, I think, for a quarter point, John. So do you think it's realistic at all that China would dump treasuries to retaliate against the U.S. in a trade war?
I don't think that's the best tactic. First of all, it's sort of inflammatory, and in doing such a move, potentially not particularly helpful to China itself. It could appreciate their currency further and make their exports more challenging. Also, they're holding about $1.1 trillion in treasuries, roughly speaking, around 5% of the treasury market. But meanwhile, yields in Germany are negative out to 10 years. Yields in Japan are negative out to 10 years. And so the global market for treasuries, I think would be okay anyway, because global growth is coming down and inflation rates have been coming down. So that's potentially more important longer term to the treasury market.
Do you believe more broadly that, as Jeffrey Gundlach told me last week, we're just set up for a whole lot more volatility in treasuries?
I think so. The treasuries have not been particularly volatile this year. Again, they've been just in a gradually grinding lower, but within just typically just a few basis points move in any given day or week. So some sort of breakthrough announcement could certainly create a short-term sell-off. But again, the broad trend due to fundamentals, due to the Fed, due to falling inflation, has been for lower Treasury rates, and particularly that's a global phenomenon when you look at global central banking policies.